Welcome back to Daily Market Breakdown. Today we're analyzing a major economic milestone for India. The GST collections for April 2025 have been released, and they've shattered all previous records. Let's break down what this means for the economy and markets. The numbers are truly impressive. India's net GST revenue for April reached 2.09 trillion. That's the highest monthly collection ever recorded, representing a solid 9.1% increase year over year. When we look at the breakdown between domestic and import collections, we see even more interesting patterns. Domestic GST collection grew by 10.7%, showing robust internal economic activity. But what's particularly noteworthy is the GST from imports, which surged by a remarkable 20.8%. This suggests businesses are significantly ramping up international purchases. According to me, several key factors are driving these exceptional numbers. First, we have the financial year-end effect. March is traditionally a month of heightened business activity as companies rush to close their books, complete transactions, and fulfill production targets before the fiscal year ends on March 31st. This naturally leads to higher GST collections in April. Second, there's been a notable surge in export activity. Many exporters have been rushing shipments before potential new U.S. tariffs take effect, what some analysts are calling Liberation Day for American manufacturing. This has created a temporary but significant boost in economic activity. Third, increased consumption has played a major role. Higher disposable income, year-end bonuses, and business incentives have all contributed to more spending, both in consumer and B2B sectors. Despite the record collections, it's worth noting that refunds have also increased dramatically, up 40% month on month. Export-related refunds in particular have surged by an eye-catching 86.1%, reaching 14,000 crore. Even with these substantial refunds, the net GST growth for the entire 2025 fiscal year still stands at 8% year over year. With total collections of 19.73 trillion compared to 18.26 trillion in FY24. So according to me, the strong GST numbers generally create positive sentiment about economic growth, suggesting robust consumption and business activity. However, just to remind you, this video is for educational and informational purposes only. I am not a SEBI-registered advisor. Please consult a certified financial advisor before making any investment decisions. Certain sectors stand to benefit more directly from these trends. FMCG companies may see higher product sales from increased consumption. The auto sector could benefit from boosted vehicle demand. Banking and NBFCs may experience rising credit demand as the economy expands. Infrastructure and capital goods sectors typically gain from higher industrial activity, and logistics and retail benefit from increased movement of goods. From a macroeconomic perspective, strong GST collections improve the government's fiscal health, potentially reducing deficit concerns and creating more room for public investment or even tax cuts down the line. To sum up, April's record GST collections signal strong economic momentum, driven by year-end activity, export rushes, and solid domestic consumption. While some of these factors may be temporary, the overall trend suggests India's economy continues to show resilience and growth potential. Again, I am repeating, this analysis is for educational and informational purposes only. I'm not a SEBI-registered advisor, and you should always consult a certified financial advisor before making any investment decisions.